Welcome to Talk Tickers, where we break down the latest earnings calls. Today, we're digging into BlackLine. Now, on the surface, their third quarter results looked pretty good, but the market absolutely hated it. So what's really going on here? Let's break it down. I mean, at first glance, you'd think BlackLine totally nailed it. They delivered just what Wall Street ordered, beating expectations on revenue and beating on profits. You can't really ask for more than that, right? On paper, this was a solid quarter. But the market told a completely different story. In the session right after the announcement, the stock just got hammered. We're talking a drop of nearly 6%. Ouch. And that brings us to the big question, right? If the headline results were a beat, why did everybody rush to sell? Well, the market clearly saw something lurking under the surface that it did not like. Let's peel back the layers and see what's really happening. So let's get into the numbers behind the noise, because as it usually does, the real story is in the details. Those headline beats were kind of just noise, distracting from a much messier picture underneath. And you can see the conflict right here in the financials. Revenue growth, okay, looks decent. Billings are up a little bit, but then, bam! Look at that profitability. It took a massive step backward. And that, right there, is the first major red flag. And this is really the crucial point for investors. Yes, they beat the estimate for this quarter, but look at the year-over-year comparison. Earnings per share actually fell from 60 cents all the way down to 51 cents. For a mature software company like BlackLine, seeing your earnings drop like that is a huge warning sign. It screams that something is squeezing their profits. But wait, the picture gets even more confusing because it wasn't all bad news, not by a long shot. The company is generating a ton of cash. That free cash flow margin is really strong. Its backlog of future business is growing at a healthy clip. And get this, they bought back $113 million of their own stock. I mean, these are all signs of a healthy company, so what gives? Okay, let's talk about what management had to say. Faced with this super mixed bag of results, they basically tried to pivot the conversation. They said, hey, don't worry about the short-term noise. Focus on our big long-term strategic plan for growth. CEO Owen Ryan was very direct about it. He basically said, look, the game has changed. This isn't about closing a bunch of small deals anymore. It's about winning these huge strategic platform deals. And to be fair, they backed it up by announcing their largest deal ever this quarter. So here's the game plan they laid out. It's a big multi-year shift. They're moving customers to a new platform with new pricing. They're going to start making money off their AI tools. They're focusing on the big fish, those large enterprise customers. And the end goal? Some pretty ambitious targets, like hitting 20% bookings growth in 2026 and achieving the Rule of 33. But as you probably guessed from that stock drop, the market is not buying this long-term story, at least not yet. Investors are looking at the promise of future gain and weighing it against the very real pain they're seeing right now. And here's why. This big transition is causing a lot of problems today. The new pricing model, it's creating friction, and customers are hitting the pause button. And here's the ironic part. Their automation tools are working so well that some clients are actually cutting back on the number of users they need. All of this is creating what analysts call an air pocket in growth, a temporary but painful dip. And you can see this uncertainty reflected on Wall Street. The analyst community is basically shrugging its shoulders. A full 60% of them have a hold rating on the stock. That's analyst speak for, we have no idea which way this thing is going to go. And after these earnings, that caution just got worse. Take Baird, for instance. They threw in the towel, downgrading the stock from outperform to neutral and chopping their price target down to $55. They called it a challenging quarter, which, is putting it mildly. Oh, and if that wasn't enough drama for you, there is an activist investor in the mix. Engaged Capital is breathing down their necks, pushing the board to just sell the company. This adds a whole other layer of fog. Are they really trying for a long-term turnaround, or are they just dressing the company up to be sold? Nobody really knows. So, let's get to our verdict. How do you balance management's optimism with the market's skepticism? Here's our take on what comes next for BlackLine. Okay, prediction time. For the next quarter, we think they'll probably hit their numbers, report inline results. But the real key is going to be their guidance. We expect them to be pretty cautious as they continue to navigate this very tricky transition. So what does that mean for the stock? Well, we see it being struck in a range for a while, probably bouncing between $50 and $60 a share. It's just caught in this massive tug-of-war between the bulls who see a big AI-powered comeback and the bears who are pointing to all the execution problems right now. Based on this analysis, we're giving BlackLine a market perform rating. Simply put, the risks and the potential rewards feel pretty balanced at the current price. And here's the rationale. The long-term potential is there, for sure, but those short-term growth problems are very real. The risk of them stumbling during this transition just outweighs the AI hype for now. And until that activist situation gets resolved and management proves the new strategy is working, the stock's likely stuck in neutral. Now, for those of you with a higher risk tolerance, all this uncertainty does create an interesting, though definitely speculative, trade idea. This is what we call our outrageous but plausible play. The core idea here is to stop trying to guess the direction. Instead, you just make a bet that the price is going to make a big move in either direction sometime over the next year. The strategy is called a long strangle. The thesis is simple. Something has to give in the next 6 to 12 months. Either the company gets sold and the stock soars, or this transition plan fails and the stock tanks. Either way, a big price swing could mean a profit for this kind of trade. And that's our breakdown of BlackLine's tricky quarter. This has been Talk Tickers, and as always, a reminder, this is not financial advice.